Let us understand minimum subscription. Minimum subscription means that when a company makes a public issue, at least 90% of the offer must be subscribed. Now, let us look at the types of companies. The main types are public companies and private companies. Let us look at the differences between a private company and a public company. A public company needs to have a minimum of 7 members, and the maximum is unlimited, whereas a private company can have a minimum of 2 and a maximum of 200 members. A public company has to have a minimum of 3 directors, whereas a private company has to have a minimum of 2 directors. A public company can freely transfer its shares, whereas a private company restricts the transfer of its shares. A public company can raise funds from the public through a public issue, whereas a private company cannot invite the public to subscribe to its shares. It can raise funds privately, including from venture capitalists or private equity investors. A private company has to have the words "Private Limited" in its name. When raising funds through a public issue, at least 90% of the offer must be subscribed. This is called minimum subscription. This requirement does not apply to a private company making a private issue. Let us look at one-person company. According to the Companies Act, 2013, a single person can constitute a one-person company, OPC. This was introduced to encourage the corporatization of micro-businesses. This type of company can avail the benefits of a private limited company and protects personal assets from liability. In 2005, the J.J. Irani Expert Committee recommended a simpler legal regime through exemptions for small entrepreneurs to save their time. Let us look at the characteristics of a one-person company. An Indian citizen, whether resident in India or otherwise, can form a one-person company. Under the old rule, the person had to reside in India for more than 182 days during the previous year. One person can be a member of only one OPC at a time, subject to the applicable rules. A minor cannot become a member or nominee of an OPC. An OPC cannot carry out non-banking financial investment activities, such as investment in securities of other companies. Under the old rules, an OPC could not voluntarily convert into another type of company before 2 years, unless its paid-up share capital exceeded 50 lakh rupees or its average annual turnover exceeded 2 crore rupees. This rule was changed in 2021.